We have these two.
That'll
work, yeah,
so
for sure.
After the video plays, he will then pop up and just put the display logo back on.
Got it.
Full screen. And then.
Sorry, I want to hear.
Okay, hey, Adrian. So we're going to. So we're gonna. So we're gonna play the video, and then right after that, Joseph is gonna pop up and just put back the display. So give him like 4 seconds to do that, and then you'll start playing.
4 or 5. Time it.
He might get 8.
Stop watch.
And then you guys can. He's gonna be sitting here.
So you want to start at 10 hours?
Some of them
What are their resources?
a few people actually before that. For the most part, we try to
Make it work.
persuade them.
Are you serious?
I was like, I guess I should like that's why when you texted me, it was like an hour before I texted you back. I was like, I just might sat down and like that.
Where we like?
You'll be in your fun room. I'm going to direct people to sit by you. You guys don't remember I said. No, I don't want to get detention. Okay, fine. Sit in the front then. Nobody does that. I didn't know what to say. I like
But now, most countries have central banks to conduct monetary policy, to regulate payment systems.
Just kidding.
Having a central bank wasn't always the most politically popular idea. But now, most countries have central banks to conduct monetary policy, to regulate payment systems, and with other regulators to oversee that country's private financial institutions. Central banks should look at the big picture to make sure that the economy is working nationwide for everyone. But we know that many people, especially low-income people, women, immigrants, are being left out. This isn't just a social issue, it's an economic one. For a country to stay financially healthy, it needs widespread participation across all sectors. Central banks are well positioned to advance financial inclusion, to help ensure a robust economy. Some banks, in fact, have already begun to take on this role. For example, the Reserve Bank of India has combined regulation and financial technology to promote financial inclusion. With their Aadhaar system, citizens can open an account with just a fingerprint. From there, biometric identification can be used as identification for state-provided services and financial transactions. Or look at Mexico, which is using fintech to move towards a more secure and accessible cash-free national payment system. And in Ghana, the central bank there has prioritized mobile banking as a way to reach populations without access to physical bank branches. As more and more countries work to improve financial inclusion, it becomes more important to understand what financial inclusion really means and why people can't get access to the services they need. Join us for a series of conversations around the future of central banking with the IMF, the World Bank, CGAP, the Financial Health Network, and central bankers from around the world, hosted by the University of Michigan's Center on Finance, Law, and Policy on Wednesday, October 2nd and Thursday, October 3rd. For more information and updates, go to our website. I hope to see you there. So good morning, welcome back. For those of you who were here yesterday, welcome. For those of you who are here for the first time today, this is the second day of our conference. Who says you can't have a little bit of cartoon fun at a central banking conference? I want to thank Jay Campbell for putting that video together. It was really a nice new touch for us to do a promo video with a cartoon in it. I'm really excited for today's conversation. Adrian and I together, as you know, are leading this project with the Gates Foundation to identify technology, business, and policy innovations that central banks could employ to better foster financial inclusion. Yesterday, we had a great set of conversations, and a great keynote speech from Mary Ellen Iskandarian of Women's World Banking about the gender gap in access to financial services and some strategies central banks can use to increase access for women and to improve local economies. Today, we're going to hear in just a moment with a keynote from Jennifer Tescher of the Financial Health Network, formerly CFSI. I can't quite let go of that former moniker. And Jen has really been a leader in the U.S. in changing the conversation about financial inclusion to focus not just on access to financial products and services, but to a more holistic view of financial health. And so we're delighted she's here. We're going to hear more about that from her in just a moment. We're obviously in an era of great technological change, a lot of innovation, a lot of new products and services being offered, new players in the market. And over the course of the day, we're going to hear about many of those innovations, how central banks might respond to those innovations or help lead innovation or get out of the way of innovation, depending on one's perspective. And really excited not only for the speakers who you're going to be hearing from up here, but also incredibly knowledgeable members of the audience, again, from all over the world. So we're going to have plenty of time for interactive conversation, for Q&A, and discussion in the break. So I'm looking forward to that as well.
So before we dive in, just a few key housekeeping items. You're currently in the auditorium, and we'll spend most of the day in here. Coffee and refreshments will be in the atrium. Our first keynote speaker will be in here, and then we'll hear from our first panel. At lunch, we'll go back to the Great Lakes room down the hall, and we'll be there for our second panel discussion. Following the second panel, we'll return to this room for panels 3 and 4 and our closing keynote. At the end of each keynote or panel, if there's time to do so, we'll open the floor to questions. Look out for the mic runners, and please do use them, as remember, we have our online audience watching with us over the next couple days. You should also feel free to tweet or use your LinkedIn to promote the conference, hashtag Central Bank of the Future, or CBOTF. I think I got that right. So we welcome your tweets and social media outputs from this. So without further delay, it's my pleasure to introduce our keynote speaker this morning, Jennifer Tescher of the Financial Health Network. Jennifer is the president and CEO of the Financial Health Network, the nation's authority on consumer financial health. She founded the Financial Health Network, then CFSI, in 2004 and has since achieved notable success as a champion for increased access to high-quality financial products and services for underserved consumers. The research that the Financial Health Network puts out is second to none and really a wonderful resource for everybody in this space, including most recently the U.S. Financial Health Pulse. I would recommend as a must-read for everybody in this room and online. Jennifer is a nationally known thought leader on the topic of consumer financial health, often contributing to American Banker and Forbes. She's a frequent speaker across a broad spectrum of industry and policy convenings, including everything from Money 2020 in Vegas to the Department of Treasury in DC. She launched the Financial Health Network's annual conference, Emerge, the Financial Health Forum, which presents cutting-edge thought leadership and showcases innovators, executives, and emerging companies in the financial services industry. Jennifer also received Crane's Chicago Business 40 Under 40 Award in 2006 and is currently an advisory council member to Action's Center for Financial Inclusion. She received undergraduate and graduate degrees in journalism from Northwestern University and a public policy degree from the University of Chicago. I also have the unique privilege of working with Jennifer as a member of the board of directors of the Financial Health Network. So I get an up-close view on this amazing woman and all the critical work that she does. So I feel particularly lucky to be able to introduce her today, and I think we're all very lucky to have her open our day 2 of this conference. Jennifer.
Good morning. That was kind of weak, people. It's early, it's cloudy outside. Good morning. Good morning. Thank you so much, Adrian, for that really lovely introduction. And thanks to both you and to Michael for having me here and for making me feel like a rock star with all those crazy tweets you've been sending out about my speaking here. Really, I'm incredibly honored to be in such incredible company. I'm quite humbled by it. This is a really expert audience. And I know that I have a lot to learn, so I'm really looking forward to the rest of today. And I hope you'll take my remarks this morning as just some food for thought as we continue the conversations. So when I was first asked to come and speak with you, I found myself flummoxed because it's really hard to think about the central bank of the future and where you want to go without getting stuck on how you get there. And then it was Bill Gates who got me unstuck. Maybe not directly, but when I called Adrian to say, hey, help, how do I think about this? She said, oh, don't worry about it. Bill said, go out 50 years. Don't be constrained by what we know about central banks today. Just think about where you want to be. Then we'll figure out how to make it possible. And I said, oh, that's something I can do. Some might find that intimidating, but for me, it really freed me up to be more creative. I was less worried about how to get there and more focused on where we want to be. And so I have 2 wishes for the central bank of 50 years from now. One, that the financial health of the citizenry is as important a goal as the health of the economy. And two, that data assets are understood to be at least as important as financial assets and are regulated and managed as such. So I'm going to talk about each of my wishes in the rest of this talk, and I'm going to explain what they have to do with each other if it's not already clear. But first, let me just say a little bit more about who I am so that you can put my remarks into context. As Adrienne already said, I'm the founder and CEO of the Financial Health Network, which until just May was known as the Center for Financial Services Innovation. And the organization has been around 15 plus years, so you'll forgive Michael and potentially even me if I stumble over my new name. We're a resource to business leaders, innovators, and policymakers who are working to improve the financial health of their customers, employees, and communities. We lead a network of 160 plus companies, including most of the big brands and cutting-edge fintechs in the financial services industries in the US. We invest in and support early-stage innovators using technology to solve financial health challenges, and we have about a portfolio of about 40 companies and organizations. We publish an annual national longitudinal survey, the US Financial Health Pulse, that measures the financial health of people in America. And we've developed a measurement methodology and a set of tools to enable a wide array of companies and organizations to measure the financial health of their stakeholders, often as part of a broader effort to implement financial health as a business strategy. Now, let me give you a few caveats. My entire career has been focused on the US market. And while I've participated in the global dialogue on financial inclusion, and I'm a member of the Advisory Council for the Center for Financial Inclusion at Acción, I have relied on many of the people in this room to teach me about the context in developing countries, and I still have very much to learn. In addition, I am not an economist. I am not a lawyer. I have been a banker, but I self-identify as a former journalist, a financial health expert, and a lover of audacious ideas that can make the world a better place. Okay, so on to my first wish. The financial health of the citizenry is as important a goal as the health of the economy. So the first question you may be asking is, well, why financial health, not financial inclusion? And in fact, I was just sitting with someone I've just met, and he says, financial health, you mean like managing people's stock portfolios? I said, no. I'm not going to answer right now because you're going to be really bored for the next hour. So, well, the reason why we need to be thinking beyond financial inclusion is because of the incredible success of the people in this room. At the rate we're going to be on track to solve the pure inclusion problem well before 50 years from now. According to Findex, just in the last 8 years, the share of adults who own an account through a financial institution or a mobile money service has increased 18 points from 51% to 69%. That is remarkable. There's no other word for it. It's remarkable. Now, there's lots of issues that remain. We've talked about dormancy. I know that those numbers aren't quite as rosy in developing countries. I'm not saying we've got it all solved, but if we think that having an account or having access is the first step, we have made incredible progress. And in fact, the financial inclusion community over the last couple of years has really begun to grapple with what comes after inclusion. And I would argue that what comes next is a focus on financial health. This really reflects on my journey and the organization's journey. We started life as an organization that was started to shine a spotlight on the needs of un- and underbanked consumers here in the United States and the role that technology could play in helping get them connected. And this is 2004. So this is the year that Google went public. It was the year that Mark Zuckerberg invented the Facebook in his dorm room. But this was pre-iPhone. So, we knew that technology was coming and changing, but we, of course, I'd be lying if I said I had any clue what was really to come. And so when you think about in the United States at least, the invention of prepaid cards, coupled with the iPhone, which came out in 2007, it really made access ubiquitous. That's not to say there aren't people in the United States or in other developed countries who don't have a bank account, but it's incredibly small. People who may be unbanked today may have had an account yesterday, and they may have one again tomorrow. And so the sort of basic inclusion problem felt like we were on the cusp of solving it. And then we had the financial crisis and the Great Recession, and that made it clear that all was not well with everybody, and that in fact, the majority of people in this country were struggling financially, and we just missed it. We were capturing the wrong data. We didn't see the fact that people were dramatically over-indebted, and that was helping them essentially finance their basic lives. And so that's when we came to understand that access wasn't enough, and that we needed to be thinking about the next chapter. And that's when we invented this idea of financial health, which I'm going to tell you about in a moment. Now, I think you already know this, but I do need to make the point that owning an account itself is great, but it's not sufficient. We talked yesterday about India, where amazingly the government facilitated opening accounts for everybody, but half of them are dormant. I can give very similar statistics in the United States. 89% of people in the United States, according to our research, have a checking account, but of those, 68% are not financially healthy. 30% aren't able to pay their bills on time, and 39% wouldn't be able to pay an emergency $400 expense with cash or a cash equivalent. Moreover, owning an account isn't always a good thing. Just look at the overdraft problem in the United States, where 7 of some of the largest banks in the United States generate at least 30% of their service charge income from overdrafts. And consumers are paying, the numbers are not as clear as they should be, but anywhere from $10 to $20 billion with a B each year on overdrafts. Look at lending products, both in the United States and around the world, that give lenders huge power to collect because they have access to that bank account. So what I'm here to talk about today, and what I really think we should care about and central banks should ultimately care about, is the outcome that we want for people. What happens after you own that account and you use it? We want people to be financially healthy. We need to raise the bar beyond consumers just being financially literate, protected, and banked, which again are all three very important things, but those alone don't necessarily mean financial well-being. So what is financial health? We define it as having a day-to-day system that enables you to build resilience and thrive, or to pursue opportunities. Many other organizations, including the CFPB here in the United States, have their own definitions. They are all roughly the same. They may use slightly different words, but they're all about the idea of having systems today that allow you to prepare for tomorrow, both managing the downside and the upside. So what's the state of financial health in the United States? Well, we created a set of indicators. How do you know if you're financially healthy? After years of research, there are 8 indicators. They are coupled around 4 basic functions that we all need: spending, saving, borrowing, and planning. And each one of those has 2 indicators. And they're not rocket science. So the indicators for spend are, I have more coming in than goes out, and I can pay all my bills on time and in full, just to give you a flavor. Or for saving, it's, I have enough short-term savings and I have enough long-term savings. And we've actually developed a score, a financial health score, on a scale of 0 to 100. And so when we survey people and ask them these 8 questions, we are able to group them into 3 categories: healthy, coping, and vulnerable. And we're also able to give them a score. And when we do that in the United States, we find that only 28% are healthy, 55% are coping, and 17% are vulnerable. Now, I want to just be clear, this is an intentionally high bar. This is not graded on a curve. And coping means you're doing okay. And for some people, they're doing more okay than others. But so it's a nice headline to say 72% of Americans aren't financially healthy. But there is a lot of, it's important to disaggregate the data, is I think what I would say. And we do that in our Pulse report. So what are we doing with all this measurement in the United States? Well, we're working with members of our network who are taking these exact same questions and measuring the financial health of their own customers. These are banks, fintechs, other kinds of financial services providers, some insurance companies. And they're then able to benchmark against national and regional averages. And they're also able to break down their own mental sort of preconceptions about who they think their customers are versus what the reality is for those customers. And they're then able to use that data and understanding to build products, services, experiences, policies, marketing campaigns that are really aimed at trying to improve where their customers need help. We've got almost 50 companies doing that. Some of them have been doing it now for several years. They have year-on-year data. Some of them are now starting to use their own transactional data in place of survey questions to be able to assess those indicators, which is incredibly exciting because it makes it easier for everybody. And we also see measurements starting to happen around the world, in other developed countries in particular. Australia, tremendous amount of work by Commonwealth Bank of Australia. There is a new national Canadian measurement survey, the results of which will be out in November. I'll be in your city, in Toronto, to talk about them, that TD Bank has been working on. There's been some interest in Western Europe in doing something similar. And so we're really excited to see this catching on, not just because it's nice to know, but because we can't hold ourselves accountable for the financial health of our customers, or even our employees for that matter, if we're not measuring. How can we know what works with the new products and new services and new things that we're offering if we're not actually able to measure? Now, some of you may be asking, what is the relevance of this framework to the developing world? Well, several years ago, in partnership with Acción, we did some work to understand that very question, thanks to support from the Gates Foundation. We did work in Kenya and India to understand how they related to this concept. From a qualitative perspective, we found that people use very similar words to define financial health in Kenya and India as they do in the United States. We then developed a tailored set of potential indicators, recognizing that, you know, these contexts are quite different, and the questions, the indicators aren't going to be exactly the same. We also recognized the need to consider other issues like absolute income level. Is there a level below which this is not relevant? This is not on Maslow's hierarchy. The role one plays in one's household. I'm thinking a lot about Mary Ellen's comments yesterday. The even more dramatic levels of income volatility. Now, Gates is funding some additional work happening right now through IPA to develop the right set of survey questions to actually measure the indicators effectively. I can tell you this is really hard. I can tell you they've tried, and the first go-around didn't yield the results they were hoping for. They're going back to the drawing board. Doing this cross-country is just incredibly challenging. But the initial work we did gives me hope that there might be an opportunity for a common framework and set of language that we can all use to be having this conversation globally. So what would it mean for central banks to have information about the financial health of the citizenry? Well, it might enable the creation of a dual mandate, that the economy is healthy and the health of citizens are healthy. And it seems like they should be one and the same thing, feeding each other, but it's not necessarily the case. So, for instance, in the United States, when the Federal Reserve lowers interest rates to encourage borrowing and to encourage growth, particularly among businesses and corporations. Those lower interest rates can be harmful to individual savers, especially to older Americans nearing or in retirement who are really counting on that interest that they're earning. There's clearly a connection between macroeconomic health and microeconomic health. Consumer financial challenges are often the canary in the coal mine that signals that the broader economy is headed for trouble. Consider the subprime mortgage meltdown in the United States that triggered the last financial crisis. Yet academics and central banks tend to consider macro and microeconomics in isolation from each other as separate disciplines. If the macroeconomy is the balance sheet and the microeconomy is the P&L, then what we're really missing in a way is the cash flow statement that connects them. And I think that financial health data may turn out to be an effective linkage. Understanding this linkage is critical to designing policies that can improve overall economic health without sacrificing Main Street for Wall Street or vice versa. Which is to say, financial inclusion and ultimately financial health need to be more than just a standalone mandate or function. Ultimately, it needs to be integrated into the broader role of central banks, and it needs to be part of their purpose. That's a word we didn't really talk about a lot yesterday. We talked about what the remit is, what the roles are, what the functions are. But if we're thinking about 50 years, what we really need to start from is what's the purpose? I think that's really important. Okay, on to wish number 2. Wish number 2 is that data assets are understood to be at least as important as financial assets and are regulated and managed as such. For the last 10 plus years, we have been enthralled with the rise of new technologies that have literally changed how we live our lives, including our financial lives. Technology gets a massive share of the credit for the progress that has been made in inclusion. The power of financial technology to expand access to and use of accounts is probably demonstrated best in sub-Saharan Africa, where 21% of adults now have a mobile money account. That's twice the percent in 2014, and easily the highest of any region in the world. But technology alone isn't going to get us to financial health. If technology is the car, then data is the fuel. You've no doubt heard the expression that data is the new oil, and that's not just figurative. So consider the world's most valuable companies by market capitalization. 10 years ago, just 10 years ago, 3 of the top 10 were oil and gas companies. Another 3 were banks. Today, at the end of the third quarter of 2019, 5 of the top 10 were data platforms. Amazon, Google, Facebook, Alibaba, and Tencent. Microsoft is number 1. There are no oil and gas companies on that list, and there's only 1 bank. That's in 10 years. The increasing sophistication of technology and computing power have crowned data king, and that's particularly true in financial services. The integrity, availability, security, and portability of data are increasingly at the heart of the banking system and the financial system more broadly. Consumers, particularly lower income consumers, often generate more data assets that are more valuable in the market than their financial assets. So consider what we've learned from the financial diaries methodology that was pioneered around the globe, and then we copied you several years ago in the United States, and in partnership with NYU and Jonathan Morduck and my former colleague Rachel Schneider, we applied the methodology in the United States and followed 235 low and moderate income families for a year, documenting every dollar that flowed in and out of their households. By the end, we had gathered 300,000 cash flows covering 100 different spending categories, 38 income types, and 69 kinds of financial instruments. The dollar value of the inflows and outflows from the typical savings account vastly exceeded the total accumulation. This kind of data and the use of it and the consumer's control over it is an essential ingredient in the recipe for financial health and inclusion. Consider the big topics on today's agenda. AML, well, that's fundamentally about identity. How can I prove that you are who you say you are? Blockchain, while I know that there's some incredible innovation going on around digital currencies, many of the use cases today are really focused on distributed ledger as a more efficient way of keeping track of the data about who owns what. I mean, that's what a ledger is, right? It's just a way to keep track of data. Data is power, and consumers don't really have very much power because they generally don't own and control their own data. What could they do if they did? Well, they could shop more effectively for financial products, having providers bidding for their business. They could trade it for preferential pricing. They could use it for identity verification. They could provide it to a lender for credit underwriting. In the US and in other highly developed economies, AI fueled by consumer data is being used to optimize decision-making. When to pay a bill, how much to sweep into savings, how to avoid a potential overdraft. Many of the companies that we've invested in are pioneering exactly these kinds of solutions. Central banks have a major stake in this issue in terms of both managing risk and creating the conditions for economic growth and opportunity. Given the constant attacks on bank data systems by state actors, central banks should be worried about both the systemic risk of breaches and the impact of breaches on consumer well-being. Meanwhile, as I said a moment ago, empowering consumers to control their own data has the power to create more market competition and drive positive financial health outcomes. Central banks around the world have been set up to manage financial assets, their liquidity, their quality, and the procedures, processes, and capital necessary to maintain a stable system. They're not set up to provide the same services and protections when it comes to data assets. In fact, no one is. The world is really just beginning to reckon with this issue. Providers in Europe are really the first guinea pigs trying to figure out how to balance a set of GDPR requirements to keep data private with the PSD2 requirements to securely share data. Australia seems to be headed down a similar path. And while there's a law in the United States that suggests that consumers indeed own their own financial data, there are no enabling regulations. And so with that void, industry has taken the self-regulation route, working collectively on technical standards, but largely cobbling the rest of the rules via two-party contracts between banks and data aggregators. And in a market with 6,000 plus banks, that's not going to end well, I suspect. I believe there's a critical role for central banks to play in ensuring that consumers are empowered. And that actually brings me back to wish number one. So my two wishes may seem unrelated at first glance. One, that financial health of the citizenry is as important a goal as the health of the economy. And two, that data assets are understood to be at least as important as financial assets and are regulated and managed as such. But in fact, they are deeply interconnected. Central banks play a major role in ensuring consumers are empowered to own and control their financial data. Only makes sense in a world where central banks are responsible not just for a healthy economy, but also for a healthy citizenry. And if central banks are going to hold themselves accountable for the financial health of citizens, then they're going to need data of their own to measure and monitor financial health. In the United States, I want to commend the Federal Reserve for being proactive on the data front. The primary tool the Fed has for understanding what goes on with households has been, for years now, the Survey of Consumer Finance, which is essentially a tri-annual survey of the ledger, who owns what. Now, 6 years ago, as our financial diaries findings and the importance of cash flow and income volatility were coming to light, the Fed added a new annual survey to its arsenal, the Survey of Household Economics and Decision Making, or SHED. It provides a far more nuanced view of the real financial lives of Americans and is a first step in taking a more holistic approach to stewarding the economy. But to highlight the cultural challenges involved in thinking differently about the role and purpose of central banks, consider that the shed is included on the Fed's website under the Consumers and Communities tab, as opposed to the Survey of Consumer Finance Data, which you can find under both the Economic Research tab and the Data tabs. But you won't find the shed in either of those two categories. As I said, I really like big ideas. It's easy to talk about big ideas, frankly, especially when you've got 50 years. But it's a lot harder to figure out how we get there from here. And there are numerous obstacles: legal, regulatory, cultural, political. And I expect that most of the conversation today is going to unearth those challenges and enable us to grapple with them. As we get into the much-needed weeds and details, I hope you will hold in the back of your mind my two wishes, along with whatever your wishes might be for the Central Bank of the Future. This convening and the Central Bank of the Future initiative give me hope that together we can both dream big and then make those dreams a reality. Thanks very much. I'm happy to take questions. Oh, I think they're coming around with a microphone. I think she had a question.
Hello, my name is Viola Llewellyn, and I'm the co-founder and president of Avamba, which is a fintech and trade tech solution for the African market. And I love how you separate financial inclusion from financial health. But I was very curious to know whether the 3 buckets of measurement for financial health that you mentioned, do you foresee a need to blend that with FICO scores to get a much better, deeper appreciation? Because a lot of times people don't actually know what their credit score means, what it can get them, or how they can use it and leverage it. And where we are on the continent, we don't even have that. So I'm very curious to know whether there is a move for such a concept.
Right. Well, that's interesting. And this, I think, is a difference of contexts. In the United States, where there is a robust credit bureau system, I would say most people, including most lenders, would tell you the credit score is an insufficient tool for actually separating goods from bads. And we, excuse me, we particularly learned that in the crisis, in the financial crisis. And in fact, here, there's efforts, and have been for quite a while, to bring in as much additional data as possible that's not credit bureau data. And so we see a financial health score, if you will, as really a more holistic view into consumer well-being. And for instance, under the borrow indicators, which would be relevant in this conversation, they are, I have a good credit score, so that's kind of factored in. And then the other is, I have a manageable debt load. Unlike a lot of credit underwriting for, say, unlike a lot of credit underwriting, we're also including in there rental payments, other basic things, so that what we would think of as being reasonable might be less than what a traditional lender might consider. I'm not at all suggesting that I think our score should be a pure replacement for the credit score, nor are we doing any work with consumers directly to say, hey, you should know what your financial health score is. We're a long way from that even being a possibility. However, some of the companies that we're working with are putting, if in some cases a score, and in some cases simply explanatory information about, hey, you took this survey, here's what we're learning about your financial wherewithal, here's some advice about what you might want to do. So we do have some early learnings about what that experience is like for the customer or the employee to receive that information. How do you handle that conversation? What else do you need to provide alongside that, or in addition? How do you keep this front and center in people's minds? I think in countries with less developed or completely undeveloped credit markets, I think there's an incredible opportunity in the same way in payments you just leapfrogged right over to digital. I think there's going to be an incredible opportunity as more people are connected into the system to be generating the kind of data that if they have the power to own and use can be very powerful. If not, there are huge downside risks here that I don't want to overlook, right? Not just about data security and privacy, but also about who's using your data and for what purpose. So that's why I think the ownership question and the empowering the citizens to own and control their own data is going to be so important.
Aisha Ahmad, Central Bank of Nigeria. The two wishes that you spoke about this morning, very compelling. So the first is, you said around us central bankers looking and focusing not only on the broader economic well-being, but that of the citizens. And the second, about looking at data and putting data ownership at the hands of the individuals. I was hoping, or I thought you were going to land around, is it monetizing that data for the benefit of each of the citizens? Is that anywhere near what you think the future holds? Because I was making the connection between how healthy you are in terms of your incomings and outgoings, and how do you generate, if you can't generate financial assets, if you generate data assets, can that actually make you more well off? So if you could speak about that.
Yes. Exactly what you said. Yes. That is absolutely a possibility. And in the United States, for instance, that's a real topic of conversation. I met with a senior executive at one of the 3 credit bureaus here in the United States a few weeks ago, and he said the future is user permissioned data. So that's the in-between step. That's not the credit bureau isn't ready to say, you can own and control it, but increasingly it's at least got to be user permissioned. So, and I think this conversation comes up a lot in the context not of financial data or assets per se, financial data, but around your social data, what you're generating off Amazon, Facebook, et cetera. But I think absolutely the same idea holds for financial data. And if we can build platforms and systems and processes that will work for financial grade data, it will apply elsewhere.
So that was a really intriguing lecture. I think one important consideration is if central banks are to have expanded mandates that would include presumably not only their traditional mandates of price stability and in some jurisdictions full employment, but were to include financial health. Would it also require that central banks be accorded a broader set of tools to achieve those mandates? Right now, it's quite difficult for central banks to achieve their current mandates using their existing tools. So do they need, for instance, the ability to engage in more fiscal, what were traditionally regarded as fiscal measures to provide subsidies, for instance, for certain sectors, to stimulate the economy, while at the same time insulating, say, savers from some of those effects?
That's an excellent question. I actually, maybe you're gonna think that I'm punting, but I actually think that's a political question, more than a Fed mandate or purpose question. I think it's a challenging question. And it's interesting because one of the things we talked about yesterday in our small groups was this idea that in less developed markets, in a funny way, the central bank is playing all roles and that as an economy grows bigger, more sophisticated, et cetera, that it may be that some of those roles peel off because there end up being other regulators, other government entities. And so it could be that in answer to your question, it may not be the Fed, or a central bank that needs those tools. It may be that there are other entities in that country's system that ultimately need to be part of playing that role. I think in a country that's in an earlier stage, it's easier to imagine them having those kind of tools.
Thank you. Just as an add-on to this question and this dialogue, first of all, congratulations to the organizer. This is a really kick-ass event. It's great. One of the things that I think we're doing here is a confluence of a few things and maybe a bit of a semantic things. I mean, I think we're using central bank as a very catch-all term. Many central banks around the world, not all, and not the majority necessarily, have supervisory authority, but many don't. So a lot of the issues that we're talking about also crosses across that supervisory issue. And when you look at financial inclusion, whether it's in the course of insurance or other areas, we do a lot of work in that area at Toronto Centre. We collaborate with CGAP and some of the other organizations. One thing to think about is the risk-based approach to supervision. Like just because something is being supervised in a developed jurisdiction and you have all these KYC requirements and everything that are so onerous, doesn't mean that when you go into a less developed jurisdiction, you have to apply the very same rigor to the smallest of items, right? And in order to bring that proportionality, you have to have that risk approach. Otherwise, what you do is you just go with a checklist of all the risks in the world. So if all of the risks are your priorities, you have no priority in terms of risk management. So I think that perspective needs to be brought into this kind of a discussion as well. So the core mandate of a central bank is monetary policy, correct? In many instances, they do supervision. Just to sum up, not all central banks are supervisors. Yeah.
Right. I really appreciate that perspective, and I completely agree about the need for tiering risk. I would say, though, in the context of my remarks, fundamentally what I'm encouraging central bankers to think about is the idea that by having a more holistic approach to putting the actual citizen at the center of their monetary policy and or supervision, that the stick of regulation is not always the smartest tool in the toolkit. And it gives you, frankly, more opportunities. The example I like to give a lot is around overdraft. In the United States, right, it's a big battle about should it be regulated like credit, or is it a service? And people are paying billions of dollars a year. But the fact is, if we as a country had succeeded in speeding up our payment system, we wouldn't have overdrafts in the first place. So central banks and governments need to be thinking about a broader set of tools than just the regulatory stick.
Thank you for being here. My name's Brian. I'm a current student here. I appreciated your points about data, thinking about data as an asset, and the question of who should be able to have control over that. But I wonder if you have any thoughts about the other side of the balance sheet, about data as a liability. I think my thinking here comes from thinking about like Equifax, right, where regulators, $125, 147 million people, 18 billion off-balance sheet liability. That's more, like the market cap is like 16 billion, more than the value of the company, that a liability that doesn't show up anywhere. So how should the central bank be thinking about that in terms of like the financial health of the economy?
I think that's a really great point. In 50 years, ideally, we wouldn't have honeypots like Equifax sitting with stale databases of data. And in a fully built out vision of consumer owning, controlling their own data, and distributed ledger technology, you sort of avoid that problem. That's not to say there aren't liabilities in the system and we don't need to think about that. It ends up being, I think, a very different problem. But again, this is 50 years. I'm dreaming big here. All set? Yeah. Thank you so much.
We are going to take a very, very short 10-minute break so people can get refreshments, caffeine out here in the atrium, and then we'll start promptly back at 10:10.
Oh, thank you. I really appreciated your question. Yeah.
Such an effective, like something the picture says about the board. I'd love to be able to use that. For the regulators, sometimes they don't see
I was just, I just have like.
any visual.
Yeah, so there'll be everything on the website.
Okay, great. Or anything. This is really.
Adrian. This is Sophie. She interned
Hi,
with me
nice to meet
at
you.
JP Morgan, and she's doing a very interesting fintech project when she was
Okay.
there. She's an undergrad, and so yeah, I thought we talked about you when we met this summer. So,
Yeah.
but so I told her you were a cool person to meet. So like,
Yes,
but
we
yeah.
spoke very highly.
Oh, good. Well, we had a great time.
Yeah. So.
Well, great. Well, you should. As you know, I'm like in and out of campus, but email me, and let's find a time to talk. I'd love to hear about the work
Sounds
you
good.
did. And yeah. You're gonna stick around for some of the day.
I'll be back around 1 o'clock.
Okay. Good. Great. All right. Nice to meet you. Yeah. Thank you.
Does it feel like so many decades?
It's a nice
Go ahead. She nailed it. She knows I'm too lazy to put my contact in. Hi. I'm an alum of Philanthropic, and I live here in Ann Arbor. I do, yeah. So my husband teaches at the law school. So we moved back 2 years ago. Wait, I didn't know that, Joanna. Oh, you did? Nope. Like for undergrad, or? Step back. That is sort of the ideal, right? Your kids are occupied, but you have free time. I have a 6-year-old and a 2.5-year-old, almost 3-year-old. So just thinking about it. Thinking about it. We love it, right? Okay, thank you. No.
Okay, as long as you're blocking that occupancy sign, which you are, y'all are so cute. I cannot.
Every year, we'll know these things.
Okay. Thank you so much, I appreciate it.
How was that meeting?
Forward to hearing
I
you
feel
speak.
nervous on meeting.
Yes.
Katrina, what's your area of expertise?
Like I said, okay.
Yes, so I'm not crazy familiar with it, but I was actually just reading about it for a presentation I had to give to the U.S. Council of Mayors. But yes, how exciting! Oh my gosh! Oh, I love to see that data. I really love to see that data. Now, my understanding though is that the amount of money is less significant than the effect it has on putting kids and families in the well, going to college is option mindset. That's my understanding of the power of that account. Oh yeah, that's the one that I've heard of.
They like to.
But what effect did it have? Okay. I didn't know there was a Lansing promise.
Are you based in Delhi?
Okay. I presented on the Milwaukee version of that. I use this example of like what actions can municipalities take to shore up the financial security of their citizens. Seattle's retirement account for citizens, CSA, and municipal fines and fees if they're doing it during North Carolina. I'm sure that would be interesting. But yeah, very interested to see that data. Yeah, sure.
Saying that I do less commute time than everybody in my here I will say postal room college.
Yeah, no, I have not.
Yeah, all right, thanks. Yeah, we can
Okay.
Slide papers, that's very knowledge. He says, Father, the fact is that India is a bit of a role model. He says, anywhere in the world you go, people are asking questions about India. So what you guys are doing is incredibly influential.
Check. 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 Check.
In the context of social and political issues, each of these things, these are not value neutral. The way technology interacts with society is integrated by the social and political institutions. We experience something. Maybe you don't want to do those things in other places. Maybe this is just right. I'm very nervous about transplantation.
Which is obviously a concern, but far bigger concern. So in my pathway sign
So that exact same story needs to be applied, in my opinion, to India and education.
We actually met her in
We built the FATF in the first flush of 9/11. But today, really, do you want that? Do you want Vladimir Putin controlling that information with everything?
well, and I can't wait for the fact that that's going to be awesome.
Yeah, you're right. So many. I hope everybody got a chance to get some caffeine, some carbs. We're going to jump right in and try and keep as close to on schedule as we possibly can. So I'm happy to introduce our first panel for the day on the central bank approaches to financial inclusion, moderated by Greta Bull.
Great, thank you, Adrian. I have the unenviable job of having to come right after Jennifer Tescher, and this isn't the first time that's happened to me. But the good news is I have a really amazing panel who are going to do all the work for me. I just have to get the best out of them. So a couple of just comments up front, and then I'm going to turn over to these guys because I think they have so much to say. And unfortunately, I wasn't part of the conversations yesterday, but in the hallway conversations and over dinner last night, I got a little bit of insight into what was being discussed. So it's clear that digital, and particularly data that digital relies on so heavily, is making the lives of financial sector regulators increasingly complicated. It doesn't respect traditional national or regulatory boundaries. It doesn't really respect any boundaries at all. And it's challenging regulators both in developed markets and in emerging markets in very similar ways. But emerging markets are facing this challenge both with really accelerated change in their markets, so the leapfrogging Jennifer was talking about, but often with far fewer resources at their disposal and just having to scramble to sort of figure out how to deal with this explosion of financial innovation. And in a lot of ways, it's really challenging the very notion of what the role of a central bank is and what the mandate of a central bank is. In addition, I've seen this a lot in my work, is there's increasing complexity and interdependence between the roles of different sorts of regulators. So we have central banks, which are often, as Babak said, separate from supervisory authorities. We have telecommunications authorities, but we also have consumer protection, competition, data privacy authorities. So there's, or we don't, actually, more commonly than not. And so there's this very volatile mix of different challenges that don't necessarily live in one place. So how do we start thinking about connecting the dots between the rapidly changing mandates of these institutions to ensure not just system stability, but to Jennifer's point, financial health, and actually I would say from an emerging markets point of view, economic growth. And how do we make sure that financial and digital inclusion stay an important part of this emerging regulatory landscape? And I think based on some of the conversations yesterday, I'd like to maybe make a couple of observations. I think there's a lot of different viewpoints here about what we actually mean by a central bank. Babak raised this in one way, but I think it's almost even broader than that. So I think just for the sake of discussion, and I think the panel here is going to maybe pick this apart a little bit, but for the sake of discussion, let's just say that that's the regulator of the financial sector, however a country decides to define that, and we'll dig in, I think, on that topic a little bit more. There's something else that has been sort of nagging at the back of my mind, because I've increasingly heard the term fintech used in the same way as the term financial inclusion. They're often conflated, and they're not the same thing. They're interlinked, and they're important to each other, but I think we should be sure to make sure that we're talking about these things in terms of what we mean. At least from my perspective, financial inclusion is financial inclusion for the poor or for people who just don't have access to financial services. Fintech is a great way of helping us get there, but fintech is concerned with a whole bunch of other things and challenging the financial system in a much more fundamental way. Financial inclusion is broader, and we need to think about how those two things are different and how they interact with each other in this broader conversation. Because I feel sometimes we start losing the meaning of the word financial inclusion in the way that it's used sometimes. So. In short, we have many exciting questions to explore as we contemplate what the central bank of the future might look like. And I have an amazing panel to help us think about this. So I'm going to briefly introduce them, and then we're just going to jump right into some questions. What we'll do is we'll have an initial discussion around a set of questions that I've shared with the panel and we've discussed online. And then we'll open up the floor to Q&A. So think now and as we go on about what your questions are. I hope we'll have a lively discussion with the floor. So introducing myself, my name is Greta Bull. I am the CEO of CGAP, the Consultative Group to Assist the Poor. It's a think tank that's housed in the World Bank. We've been around for about 25 years, since 1995. We're very focused on how financial services, technology can help really bring benefits and impact to the poor. So including poor people in the financial system should have an impact on their lives. We do a lot of research. We partner with a lot of the organizations here. So to my right is Deputy Governor Lobna Talal, who started her career in banking and investment banking. In 2004, she joined the Central Bank of Egypt to develop and execute a full-fledged two-phased banking sector reform program. And in November 2011, she was appointed Deputy Governor responsible for monetary stability and was the first female to assume this position in the history of the Central Bank of Egypt. In 2016, she led an effort to enact a program of comprehensive fiscal and monetary reforms to put the Egyptian economy on a stable path to growth. Among many other accomplishments, and I had a hard time summarizing her many accomplishments, she represents the Central Bank of Egypt in its capacity as chair of the board for the Alliance for Financial Inclusion. Sophie Maddens, who's just two steps down, is the head of the Regulatory and Market Environment Division of the International Telecommunications Union. Sophie's worked as a regulatory and policy expert in the telecommunications and ICT sector in many international environments, including Asia, the Middle East, the Americas, Europe, and Africa, which is pretty much everywhere but Antarctica. Her scope of expertise is particularly focused on the information economy, including internet policy and governance, e-commerce, privacy, cybercrime, and cybersecurity. Ajay Shah, who's two steps down, is a professor of economics at the National Institute of Public Finance and Policy in New Delhi, where he co-leads the macrofinance group. He's held prior positions at the Center for Monitoring the Indian Economy, the Indira Gandhi Institute for Development Research, and the Indian Ministry of Finance. He's engaged in academic and policy research in the fields of Indian economic growth, open economy, macroeconomics, public finance, financial economics, and pensions. And last but not least is Michael Wiegand, who's at the far end of the table. Michael's the director of the Financial Services for the Poor initiative at the Bill and Melinda Gates Foundation, leading the foundation's efforts to make high-quality financial services available to poor people throughout the developing world. Before joining the foundation in 2016, Michael spent 10 years with Standard Chartered Bank, holding senior level positions both globally and in the Southern Africa region. And prior to joining Standard Chartered, Michael consulted to financial institutions in the US, Australia, Eastern Europe, and the Middle East with McKinsey. So a big welcome to all my panelists. So we're going to start out with a fairly broad question, and I'd like to start with Lobna. Has it been enough to have only an implicit financial inclusion mandate embedded in the core mandates of central banks, or should inclusion be an explicit mandate? And beyond that, now that access to accounts is nearing universality in some markets, not all markets, how do we think about what comes next in terms of financial inclusion policy? What might be some of our priorities for financial inclusion 2.0?
Good morning, and I'd like to thank the organizers for inviting me to this event. The title of the topic is quite intriguing, Central Banks of the Futures. I think a few of us at the central banking community are trying to phrase it this way. We go about our daily work, and maybe work towards a central bank of the future, but it has never been brought up as a logo. So I thank the organizers and Mitch and the research center here for putting this in this perspective. I think when it comes with regard to financial inclusion, this topic, especially for developing countries, has been coming up lately very much on the agenda of countries, not just central banks. And it has not been expressed as an explicit mandate for central banks in developing countries, but I think many of the governments, and I talk about Egypt specifically, have seen in the central banks the right institution where they can lodge this mandate. But having said that, it cannot be done without a collaboration at a national level. We've heard the question today whether it requires fiscal decisions. Yes, it will require fiscal decisions. It has to be a collaborative effort, but it is important that there should be one entity, one core that is in charge of putting the agenda, the priorities, and then aligning all of the other stakeholders around this agenda. Why should it be lodged at central banks in general or regulators if it's not specifically a central bank? Because I think the dual mandate that most of the central banks have now, which is monetary stability and financial stability, are the same sides of the coin when it comes to financial inclusion. When I talk about financial inclusion, especially in developing countries, we're talking about countries that have a large informal sector. This informal sector is lost opportunities for the fiscal. It is also a social and political source of unrest. And only through financial inclusion will we be able to address this informal sector and bringing it into the formal sector. So it is quite important for developing countries specifically. For all countries, it's important that financial stability in terms of availing financial services through diversified financial institutions. It doesn't have to be the banks only, as we see in what has been emerging now, but they have in one way or the other be formal. regulated in a way. It doesn't have to be the same set of regulations, but it can be a tiered regulation atmosphere, be it the fintechs, be it the telecos, and that brings me back again to the issue of cooperation between different entities as well. Even from a monetary stability point of view, I mean, when I have a large informal sector and a large informal economy, my transmission mechanism and my monetary policy tools are ineffective, or they are slow because whatever I do with the traditional tools of interest rate movements will not resonate. The transmission mechanism will not be effective if I have a large informal economy. So it is, again, in the interest of central banks, if they want to fulfill their mandate of price stability, is that they have a proper operating financial sector with a large financial inclusion ratio and active ratio, not just a dormant financial inclusion landscape. So all of this add to it, for example, for financial inclusion. Financial inclusion, as you rightly said, we have to define what we're talking about, is also includes financial education, financial literacy, financial health, as we've heard today. And this all is important for a central bank when fulfilling its basic two mandates of financial stability and monetary stability. So they all come in play. And I think at one point in time, they might become an explicit mandate for central banks, but even now with this implicit and in a cooperative and collaborative effort at the level of the whole country, we will be able to get there.
Thank you, Lobna. A lot of interesting food for thought in that, actually. Michael, could you maybe speak to the same question?
Right. Yeah, it's across the developing world, financial inclusion is an explicit mandate of many central banks. And even beyond that, in countries where where the majority of citizens are excluded from the formal financial system, financial inclusion is a top political priority. And more often than not, the central bank or financial regulator is the owner of the financial inclusion strategy. So in most of the countries in which we work, it's not even a question of whether it's part of the mandate. I think Governor Halal, Deputy Governor Halal, I think mentioned the close linkages between stability. I think formalizing the economy also brings tremendous liquidity into the system, which can aid stability, and she mentioned the transmission of monetary policy. In terms of what are the next steps, I think there's a real proximate issue around credit and what's the role in central banks in promoting credit and making sure that credit reaches all sectors of the economy. And again, already and for many years, some central banks are very active and take a very interventionist role in ensuring that a wider set of the economy is reached through credit. I mean, ultimately, we sort of think about it as, the financial regulatory system is there to make sure that the financial system works. We want to make sure that the financial system works for everybody.
Yeah, that's nice, actually. That's a nice way of framing it. Okay. I think I'm going to move on, but I may circle back to some of the points raised on this because we have a lot to get through. So I'd like to put this question to Ajay and to Michael. So universal financial access requires a lot of infrastructure, actually, like payment and information systems, so credit, to your point, Michael, ID, KYC utilities, ICT, and telecommunication systems. And it requires that these infrastructures are efficient, effective, open, which they're not always, and adaptive. So how should the central bank, should the central bank of the future be providers? Should they be regulators of this infrastructure? Or should it be separate? And at the very least, should they have a mandate to proactively intervene in such areas to achieve a financial inclusion mandate? And Ajay, I'd like to start with you on this because obviously India has been very forward-looking in building public good infrastructure, and I know you have a lot of thoughts on this.
So in India, the government has played a leadership role in a great deal of the infrastructure. There is a giant biometric authentication system that is called Aadhaar. There is a payments infrastructure organization that is called the NPCI. And there are many engineering standards that are drafted by the government and pushed into the economy using state coercion. And this has yielded some gains, and there's no question that there has been progress made through these channels. At the same time, I'm a bit nervous about this state-led approach. We should be more cautious about the role of the government. And I would like to say this in a couple of different ways. The first is that I think all of us in this room, we are in the field of financial inclusion, and we appreciate that financial inclusion is hard. There are no simple recipes. And I think that the methods and the techniques that will work in a given locale will not work in another. We need a great deal of innovation and exploration to figure out what's going to work. There is the ever-present danger in the state-led approach that some central planners in the government will choose some business model, will choose some standard, will choose some framework and push it into the economy. And that may or may not be the right one. These high modernist experiments have often worked out poorly. So I think the essence of how we will get there is a vibrant market, is competition, is innovation, is experimentation. And we will end up with many different solutions, particularly in a country like India, which is a large country, but also an extremely diverse country. The richest parts of India are divided by the income and prosperity in the richest parts of India divided by the income or prosperity in the poorest parts of India is the same ratio as the richest parts of Latin America divided by the poorest parts of Africa. So India is very diverse, and that emphasizes the need to find many different solutions that are useful in different parts of the system. And I'm very optimistic about the role of technology and business model innovation that technology makes possible. But that's not consistent with a state-led model. It is also not consistent with a domination of banks and banking. And I think that too often in India, the levers of policy are controlled by the central bank, which tends to look at the world from a banking point of view. And I very often get the feeling that central bank officials and bank employees would like for this entire technology revolution to turn into some technology vendors who will serve the banks, but not really cannibalize the banks, not really threaten the revenue streams of the banks, not compete with banks. And I think that that's selling ourselves too short. I think that the scale of innovation that is required to be in this needs to be a greater thing than just being vendors to banks. So I think that in India, we've got too much central control. We've got too much of business models that are controlled by the government. And that generates regulatory risk, because the government can support your business model today. It can change its mind tomorrow. And there is a lack of due process. There is no notice and comment. The democratic legitimacy of the regulatory process is not there. So things change suddenly. For instance, 2 weeks ago, the Reserve Bank of India decided that fintechs shall be cut off from credit bureaus. Okay? So too bad if you are a fintech that was going to use data from a credit bureau, you're just in a lot of trouble because you're told that you can't use a credit bureau. So I could go on these difficulties, but this is my quick idea that I think we've got a lot of central planning and state control in a field that I think would thrive more as a self-organizing system, as engineers and entrepreneurs inventing solutions to local problems.
That is super provocative and in a good way. And I want to just for a moment sort of capture a question that I'd like to explore as a bit of a surprise for all of you. There is this tension between control and innovation. And we've seen, particularly in markets where banks have a pretty tight hold through the central bank on what innovation is allowed to happen, that it's slower, right? So if I compare Kenya with Nigeria, we've had a very different pathway towards financial inclusion. And that's not to say one is right and the other's not, but it's a trade-off and a tension. And it kind of often comes down to a governance question. Who's in charge of this? And how do we come together and agree? And it's complicated because in a market like Kenya, huge amounts of the payment systems are going through mobile network operators, and yet the payment system's controlled by banks. And it creates a tension. And I think that's a really interesting tension for us to explore. So I want to just flag that maybe we'll come back to this and get your thoughts collectively on it. But I wanted to actually put the same question to you, Michael, on infrastructure and how those help the market, but also this question of, what's the role of the central bank of the future in that infrastructure?
Yeah, so I don't think there's any question that some of these platforms have huge impact in driving financial inclusion. So for example, basic KYC, traditionally where you had to gather documents and make photocopies and move those around, there are a lot of estimates, but generally between $15 and $25 to open up a bank account just for the KYC process. With Aadhaar in India, again, all that information gathering was done by the government for the purpose of setting up the national ID. Banks and financial service providers, you give your Aadhaar number, you give your fingerprints, and immediately you're KYC. So the estimates is it's brought it down from $15 to 6 cents, right? So now a vast majority of Indians who would never have been profitable if you had to spend $16 to $20 just to get them onboarded, now you can serve them profitably. So I think these platforms are tremendously valuable. There's a question as to, left to their own devices, would the private sector have created such a system? And I think they're natural monopolies, right? Many of them, payment systems, some of these ID systems, if you want them to be ubiquitous. And so at a minimum, I think they need to be regulated, right? So that if they are owned and operated by the private sector, Ajay mentioned NPCI, who's the payments company of India. It's an independent company, but it's heavily regulated, and there's a lot of oversight by the Reserve Bank of India. And so I think that's the balance. And you put your finger on it. You want to drive innovation. Technology is moving incredibly fast. The whole ID space, protecting people's privacy, protecting security, will be a real challenge. These are, honeypots, I think, as Jennifer used, for criminals, but also for, malevolent governments. And so striking the balance where people are protected, both from a security and privacy perspective, is going to require constant innovation. And central banks may not be best positioned to be at the cutting edge of innovation. And so I think it's a real tension, but we can't get away from the fact that these platforms can be hugely valuable.
Okay, so building on that, recognizing that governance of a system that we're even kind of struggling to define what the boundaries are because it's changing so fast. So how that gets overseen and governed is still a pretty open question in a lot of markets. So what I'd like to do is then turn this but with a twist, to first Sophie Maddens and then to Deputy Governor Talal, about a culture of collaborative regulation for digital transformation. So how do we start thinking about, say, telco regulators working more closely with financial sector regulators and making this a more joined up system? How do we have regulators talking to the industry that's producing these services and really understanding each other in terms of both the opportunities that Michael spoke to, but some of the risks that Ajay spoke to? And what other agencies are important in this equation? So we've got consumer protection, we've got data protection, we've got competition issues. So how do we effectively collaborate across these different regulatory mandates, or in the case of some countries, regulatory gaps, to be honest? So Sophie, maybe you could take this question first, and then Logan, I'll turn over to you.
Thank you very much. And I'm kind of the ugly duckling in the room. I feel like the odd one out, and yet I'm not the odd one out, because the message really is about collaboration, and it's become more and more part and parcel of the narrative. It's about collaboration, it's about digital transformation. Digital financial inclusion without the secure, trusted, reliable infrastructure leads to no financial inclusion, because you need that secure, trusted infrastructure. And I really want to call out to the Gates Foundation and to the World Bank. We're working together on a project, the Financial Inclusion Global Initiative, where we have working groups on security, trust, and infrastructure, on privacy, data protection, but also on national implementation in 3 countries, Mexico, China, and Egypt. And both partners have really recognized that the ICT component, leveraging ICTs to achieve financial inclusion, is core to our mission. And we've come a long way. You say, how do we go about collaboration? Well, collaboration is actually already there, and I don't know how many of you know ITU, the International Telecommunication Union. We're a specialized agency of the UN, and we're unique in one particular sense, in that our membership, we're membership-driven, and our membership includes the private sector, includes academia. And some of you might have participated in some of the work of ITU, in particular our T sector, so our standardization sector, our radio communication sector, our development sector. But our standardization sector has focus groups on digital financial services, where many of you may have participated. We have a focus group on DLT. So we're looking at the technology. In the development sector in 2016 in Egypt, we brought together financial and telecoms regulators in the Global Dialogue for Digital Financial Inclusion, where we came up with some guidelines, some core principles for that collaboration, and identified some of the issues where there is the need for synergy, the need for collaboration. Just as a funny anecdote, in some of the countries where we've been on mission, there are silos and there are turf battles. And we come into the room and people say, what are you doing here? We're the central bank. We're dealing with payment systems. And I'm like, you know what? When the mobile network goes down and the money goes poof, who are they going to come to? So consumer protection, quality of service, interconnection, interoperability. These are issues that the telecoms regulators are working with. But as Lobna was saying, there needs to be that collaboration because there's payment aspects. Just one more point on the collaboration. People do mention the example of Kenya. I love the example of Kenya because we need to balance flexibility with stability, innovation with investment incentives. In Kenya, they saw Safaricom was looking for new business models. They were looking, how can I up my game? How can I bring more revenue for me? Because at the end of the day, they're doing business. There were champions in government, visionaries, who brought together the central bank and Safaricom and the telecoms ministry and the telecoms regulator. And they said, this is important because it will allow our diaspora and our rural communities to be brought into the digital economy. Let them give it a try. Let's be light touch regulation. Let them give it a try. We'll see afterwards if and how we need to regulate it. And it made a huge difference, not just in Kenya, but around the world. So collaboration is there. We have these pockets of collaboration. For that, we need to sit together. We need to learn from each other. We need to exchange experiences. Maybe we need to define principles of collaboration and I'm a lawyer. So I always think there needs to be the legal mandate. There needs to be the basis to go back to, because we need the human infrastructure, the technical infrastructure, and the governance infrastructure together. And together we will succeed.
Well, that was very inspiring. How about this from the central bank point of view?
I'll just be very frank. It's not an easy way to navigate. It's quite challenging. If you allow me, I just fall back on what we did in Egypt, because there are lessons to be learned and things that we can do better also in the future. We have a National Payment Council that is headed by the president, so it has a lot of political authority and will, and it brings everybody around the table on the same, on one agreed on agenda. So we have all the ministries or the regulators, and the Central Bank of Egypt, again, being at the forefront, is the secretary of the council. So we drive the agenda, we put the agenda, and we have the collaborative effort between all the entities. So this is a very important tool so that you can get things moving. Having said that, it is still difficult because, again, some people might like to work in silos. Some people feel that this is my area, I don't want to relinquish it. But I think with the importance of financial inclusion and trickling down of economic growth to the masses, you get the buy-in of others, of the other entities, because it is a highly a political and economic target, so everybody has to align. But we still have to broker a lot in that. The idea is, I think that we have to, this is at the national level. Now, when we come to talk to regulators among themselves, we were discussing this yesterday, there is a difference between regulating maybe the entities and licensing them and regulating the activity. There could be an activity that is cross several regulators, and that's here where you need to coordinate together. So we have done this in Egypt, especially with the teleco operators, because we have a large mobile wallet portfolio. And so we try to regulate the activity. If you are doing anything related to payments, then the central bank has to come in and put all the criteria. The AML has to be there also involved so that they put the criteria for the KYC and everything. And the teleco also have to make sure that it is a playing field for everybody. And it was successful. And maybe one of the lessons learned is that when you do it on a very macro level, things might just not happen. But when you sometimes use use cases, you come in with a specific case that you want to bring. And this is something that is really very close to my heart and relates yesterday to what Mary was saying is the gender, the women issue. So we have an MOU with the telecom regulator. And the first thing we brought to the table was, we want to have a tiered KYC for mobile wallets. This is plays in the interest of both entities. So, and the AML came in and we were able to do that. And then when we try to apply this for women specifically, because they have their challenges when it comes to eKYC, which was a very clear case for women, which was the state was paying alimony to a lot of the divorced women. So we structured the product so that these payments could be done through their mobile wallets, regulated, lightly regulated and KYC'd because the amounts are small and these women have their own particular circumstances. And the product came out and is successful. This encourages us to go to the next project and the other one. And then all the stakeholders feel that they are part of the success story. And so they continue to collaborate with each other. So you have to define the formula and to share the success and make it the success story of each and every entity. It's not just one, so you can make sure that you don't have people saying, no, you're stepping on my toe, or you're taking off my responsibilities. So that was what we did in Egypt, and so far it's going well. And I think we're doing it with other regulators. We have, for example, now our sandbox when it comes to fintech, and the first cohort there is for eKYC, but this meant that we had to have an MOU and a collaborative effort with the banking regulator, which is the central bank, the non-banking regulator, which is a different entity, the AML, and the NTRA. They held also, well, now, as the sandbox is at the with the Central Bank of Egypt, but through this MOU, I'm able to get all the other also regulators so that we can bring something to the market together.
Okay, thanks very much. I think, Sophie, you wanted to come back in on that.
Yes, thank you very much. And I really think the project in Egypt with the women having access to the subsidies or to the payments through the mobile wallet, I'm aware that there's a collaboration with one of your mobile operators. But one of the questions I want to put here, I think when I say finally we're talking about collaboration, finally we're hearing about digital first, I think we're also hearing about financial inclusion first. But I'm wearing here the SDGs, the SDG pin. It's eradicating poverty, it's gender, it's education. So I think together, digital financial inclusion for what? We can make people's lives better. And I think when we talk about collaboration, we really have to think even further out of the box. We have to stretch it even further. It's not just bringing mobile wallets to women, but it's about teaching them the digital skills. And I know in Egypt you do a tremendous amount of work in digital skills, awareness building. And also, let's not forget one group of people, persons with disabilities. We had the keynote on gender yesterday. There are billions of people in the world with disabilities. Please, let's not forget them in our financial inclusion work and in our digital skills campaigns, because if life is tough for women, for youth, It's even tougher for people with disabilities. So we really need to keep them in our thinking and at the top of our thinking as well. But just to come back to the point, holistic collaboration, that digital financial inclusion for what? I think that brings us out of the box even more.
Okay, so I want to move us to a new topic, but just to maybe summarize some of the points on this one, because I think they're useful. So it's quite clear that there's a balancing act between control and making sure things don't run amok, and innovation. And it's pretty hard to get that right, but that collaboration and talking to each other is a pretty important part of that. I think what you were saying, Lobna, about actually being clear about what you're trying to solve for up front is really useful to bringing those pieces together. But actually, I think what Sophie just said, beyond that is thinking about, well, what's the outcome we're trying to achieve? So what will this do for people? And I think that's a really interesting way of tying it together. But let's move on to a new topic, which is, how does what we have need to change? So, central banks are already pretty challenged to implement balanced, risk-based approaches to traditional banking models, which are the foundation of global financial regulation and supervision. And while these new business models and technologies hold pretty major potential for inclusion, they also pose serious challenges to traditional methods of regulation and supervision. And that suggests that pretty radical changes are required to get to the central bank of the future. So I'd like Deputy Governor Halal, Ajay, and Sophie to speak to what shift in this landscape do you think is most important? And how do we need to think about placing the regulatory perimeter for the central bank of the future to be effective in balancing both those opportunities and the risks? So perhaps we could start with you, Ajay, because you haven't spoken for a while.
I think we should see this question in the context of the larger puzzle of the emergence of state capacity. For many people in this room, you take a reasonably capable United States government for granted. Okay? When the United States government chooses to build a new organization or a new agency, it pretty much gets done, and by and large, it works reasonably well. I come from the opposite corner of the world, where every day there is the battle of state capacity, that the Indian state is overwhelmed, is trying many things, and is challenged in doing most of them. So from a state capacity perspective, it seems to me that the way to get to capability in a central bank would be to have a more narrow mandate and to have more clear accountability. So I think that the title of this conference, The Future of Central Bank, as many others have emphasized, is actually a larger thing. It's about financial economic policy, which could have an agency landscape of many, many organizations and not necessarily the central bank. But my policy instinct is that it is better to have more narrow organizations with more clear accountability, to have measures of accountability around each organization. Sprawling mandates are more troublesome in terms of getting performance. If I'm supposed to do many things and I'm not particularly measured for many components of them, then I'm more likely to be able to claim that I could not do X because I was pursuing Y. And it helps if Y is not particularly well measured. So I really appreciated the morning points about measurement, and yes, we should go there. But I would also appeal to an old economics idea of the assignment principle, that you have one instrument, you have to dedicate it to one objective. Let's not confuse things by having complicated organizations with many objectives. In all probability, those organizations will do the things that none of us consider useful. Finally, bureaucracies pursue their own objectives, and they're not going to care about the things that we consider valuable.
Okay, so I might come back to you on this because I think very interesting what you say, but then I think there's a question of how you connect. So maybe we'll let you come back at the end. But I'd like to hear from you, Lobna, about how you think about shifts that need to get us to what the central bank of the future looks like, but also where you draw the lines in that perimeter.
I just would like to comment on what has been said by Ajay. I believe when you have such a topic like financial inclusion that we have seen and throughout our discussion, it is so multi-pronged and multifaceted that having these narrow mandates given to organizations, I think we will end up with more regulatory things falling between the cracks than a more comprehensive thing. Having said that, I feel that still, whenever you enlarge the mandate of any institution, be it the central bank, be it anything, there has to be accountability. So you have to bring in the idea of KPIs, measures that against which your performance is measured. And within the organization itself, you have to have dedicated teams with a very clear mandate, but that can coordinate among themselves and also with the other stakeholders outside the institution. So I'm not personally for the idea of having it more more specialized. No, I think there has to be one entity, regardless what it is, that sets the agenda, that puts the framework, and is responsible for some of the deliverables in coordination with other entities. Where to draw the lines, I think the topic is so vibrant. I mean, every day we are coming with new ideas. I mean, at the beginning, it was just simple financial inclusion, people having accounts. Today, we are, which was like not too far away, 3 or 4 years from Findex 2014 to 2017. Now we find there is a jump, but we are not happy. Everybody's saying, what about financial, what about dormant account? What about the gender gap? What about the gap between, what about the quality of the services? Did it do the right impact? Is it really increasing and helping in the financial health of citizens? Is it doing the poor any good? Or are the poor getting even much more leveraged or endangered? So, I mean, it is always coming with new challenges and new things. So the topic itself is increasing. All you need to do is really focus on what we want to achieve. So it hasn't become just financial inclusion. I think what we are doing now, and which is very important, especially for developing countries that are just going after the financial inclusion in terms of accounts, that they now bring into the equation the idea of impact, the idea of financial health, the idea, what Sophie said, what is it that we are really targeting now? And this has to be done in a collaborative effort, but there has to be one entity, regardless what it is, which entity it is, that can set the agenda and raise the alarms. This is, here we're not going right. And also allocate the resources, because especially in developing countries, we don't have endless resources, be it human capital, be it financial resources. So we need to allocate how can I use this resource to get the most important impact? Or do I need to work on the infrastructure now, or do I need to work on specific use cases because I need to address certain social and economic problems? So it is quite vibrant and.
So I'm actually hearing agreement between you guys on the need for maybe clarity, but then there's maybe a difference in terms of narrowness and how that comes together, and we'll come back to you on that, or a broader scope. Before we move on, we come back to you, Ajay, I'd like to hear from Sophie and her view on this.
So I think I agree with both. At the end of the day, it's government that needs to set policy and a vision and needs to determine how it will allocate its resources. I think, coming to Ajay's point, we need entities that are fit for purpose. So you need to decide on the purpose, what is the mandate, and it can be a larger mandate or a more restricted mandate, but that needs to be clear. And then you need, I come back to it, the human infrastructure, so you need the capacity. It makes no sense. In the telecoms field, we saw many countries that set up regulators because that's what the donor agencies told them to do. They didn't give them training, they didn't give them the financial resources, they didn't give them the structural, functional, or financial independence, but they gave them a whole wash list of things to do. These poor people were not able to do it because they didn't have the tools that had it. You need the technical infrastructure, so you need the investors, the innovators that come and bring the technical solutions for what you're trying to achieve. And you need the governance infrastructure, which are the rules, the procedures, the processes, including the processes for collaboration, because none of us are superhuman. So even if you have a large mandate, that comes to the restriction in resources or indeed the technical capacity. And that's where you need those collaborative mechanisms. And let's not call it regulation and let's not call it obligation, but just a simple collaborative regulatory mechanisms that is a process that it is enshrined in certain administrative rules so that you can get the help when you need it.
Ajay, would you like to come back on this point at all?
We should learn to walk before we can run. And therefore, it is better to start out with an agency, an organization, which is given a smaller problem and get to high levels of capability and then muddy the waters as you go along. So we should think of the sequencing question, that it's always important to start with something, make it work, and then potentially we could make it more complicated. And I will go back to the assignment problem that if you wish to put two objectives on an agency, you will need to give the agency two instruments. And we'll need to construct the measurement systems to hold it accountable. So you are absolutely right that the boundaries are the design decision of each country and in each context, and there is no one answer. But I think that we will all agree in a principal agent problem. If there is a contractor who is fumbling on doing one problem, would you give him two problems? Okay, so in that principal agent problem between Parliament and each of these agencies, we should start small, develop high capability, and then escalate it.
Okay, I'm going to now bring Michael into this conversation, but shift gears a little bit. So we've been talking about this in a national sense up till now, really. But data and financial services now move across borders very easily, sometimes without regulators even really having much of a grip of what's going on. And so the question that I'd like to maybe start with Michael on and then move back this way is, is there a risk that central banks will actually lose their relevance as financial sector regulators and supervisors as we think of a Libra coming on board? Or, and then how do central banks need to think differently about regional and global regulatory frameworks, and how do these need to evolve from where they are today?
So I think there is a risk of irrelevance, and there's, in a very small scale already emerging these sort of alternative financial systems that are outside the regulatory regime. So I think one answer is that central banks need to reassert their sovereignty over financial systems, right? So for example, a requirement that any deposit account or store of value account has to have a geographic domicile, and therefore the regulator in that area governs that product, and you can have rules about how a system is operated in one country if it's domiciled in another and have regulations. So I think there are ways that central banks can reassert their sovereignty, and I think it's important that they do. In terms of the question around cross-border, I don't think there's any doubt, and had a conversation this morning with the governor on cross-border payments. Our existing cross-border payment system is antiquated, outrageously expensive, and that's what's giving rise to some of these alternatives. So I think there's work that needs to be done by regulators to modernize the cross-border payment system. There's already a lot of regional efforts. We provide some financial support to the West Africa Economic and Monetary Union, which is a collection of West African countries that already have a shared currency, a single central bank, and payment infrastructure that works across borders. That's a bit easier because they do have a common currency, but there's several other regional efforts. The SADC countries, the Southern African Development Council, already has infrastructure that enables wholesale cross-border payments, not necessarily cross-currency, but they're looking to expand, and there's many other efforts to bring down the costs of cross-border payments. So I think that level of collaboration is coming, and it's a new role for central banks, both in terms of payment and also currency conversion directly between currencies. And the former governor of Kenya was active in leading some efforts across East Africa to think about how to enable direct currency conversion between East African countries. There's a lot of trade in these regional areas, and the payment and monetary systems have to catch up. And then finally, you talked about standards. I think certainly the global standards setting bodies are and will continue to need to modernize, and as you know, in parallel to national regulators thinking about these new systems, the standard setting bodies will have to come along with that.
Sophie, would you like to tackle that question?
When I look at the cross-border payments, again, I come up with, in my mind, I think of the ICT-related issues or the ICT telecoms-related issues, pure infrastructure-related issues, roaming rates. We all know that there's international mobile roaming. So when you use your mobile phone in another country, so these roaming rates are of importance. But then we're coming to the crunch issues, ID, privacy, data protection. And there are four. I think it is very important, especially for regulators or central banks from developing countries, to be part of the discussions. And there are four around the world. I think of all the initiatives the Gates Foundation, they're doing, what the World Bank is doing, what ITU is doing, what AFI is doing. Internet governance issues that are looking at privacy, data protection. You have the IGF, the GAC. We had our global dialogue on digital financial inclusion, again, where we brought people together, because if you're not part of the discussion, discussions will happen and decisions will be made, and it may not be made in the best of your interests. So be involved in those discussions. And that, I think, is a message I want people to come away with.
Ajay, I'd like you to respond to this question, but, and particularly in the context of India sort of exporting a lot of ideas now. So how do we think about not just cross-border, but sort of cross-border flow of data, cross-border flow of ideas? How do we think about how these regulatory frameworks, both at the country level, regional level, but also the global level, how do they need to shift to accommodate this very radical transformation in the financial sector?
I think two things, if I may now start doing some dreaming for 50 years. Yes, that's a nice end game of this session. I think there are two things going on. The first is we should see the free trade problem in data as analogous to the free trade problem that we've known for 200 years. That there will always be the short-term political economy of trying to do some protectionism, of various kinds of nativism and nationalism that will come in the way, and that we will always be better with more open, more free interconnections between individuals and firms that cut across borders. So I see the present difficulties around data as just being the Corn Wars all over again. That we've been through this movie over and over for hundreds of years, and this is just the latest skirmish of a long tradition of battles around free trade. And in that sense, I think that we need to think about the institutional arrangements that were used by the world in the past to overcome problems of free trade, whether it was the GATT or the WTO or the European Union. I think we have to ask ourselves, what are the cross-national frameworks that will give us a more benevolent approach to this? Because it can collapse into nativism very easily. As we're seeing this all over the world, it is very easy for this to go wrong. So I think this would be one part of my big thinking, that how do we make the world safe for the new world of data? Let's recognize that this is a new milestone in the history of mankind. We kind of went through free trade in agriculture, free trade in goods, and a certain kind of free trade in services. But in the data economy, how are we going to rethink free trade, and how are we going to underpin it in the legal foundations of agreements and coalitions of countries that will come together jointly to make those agreements, create passporting arrangements? I think we're at the beginning of that story. And my second 50 years idea, this is a provocative thing that I think we should all start thinking about. At present in the world, we have perhaps 150 currencies. And 50 years from now, do we really need 150 currencies? Is a currency like a national airline? Is a currency like a national stock exchange? Is it really feasible and efficient in this world of the efficient ability for residents everywhere to use the US dollar or to use the euro or to use Bitcoin? Okay, is it feasible for subscale currencies? Okay, and then the kind of arrangements you described are so important that this is the most important puzzle that we're going to need to figure out of how do groups of countries come together? How do we arrive at agreements around sharing the seigniorage revenue? How do we protect ourselves from yanking access between countries? And I wish to hold for you a great example of a success story in global cooperation. Did you know India and Pakistan, through the worst of times, have protected water sharing treaties on the Indus River? So the Indus River starts out in India and goes into Pakistan. And through the worst of times, the treaties have held. So I think that it is possible to create the cross-country legal frameworks for cooperation and collaboration in something as sensitive as water, and it can be done for something as sensitive as currencies. And I think it behooves all of us to start working towards that on the 50-year horizon that Adrian asked us to think about.
Yeah, I think that's a really great comment. My only question is whether 50 years is the right time horizon. This is all happening a lot faster than that, so maybe we need to think in a shorter time horizon, but great question. Yeah.
To this theme, because I think it's also very important. I think we also, especially when it comes to financial inclusion, we need to erase this divide between developed countries and developing countries. I think we are faced, both of us, with the same threats, the same disruption, and I would say even at the same level. So I hope that also in the next 50 years, we don't have this division between developing and developed countries in this topic specifically.
I love that comment, and that takes me to my next question, which I'd like to direct to you, but then also to Michael Wiegand, and it's sort of a two-part question. So central banks and governments are run by human beings, and I think the only perhaps differentiating factor, to your point, between developed market central banks, for lack of a better word, and emerging market central banks is resource, both in terms of capability and human resource, but also just number of people, technology tools people have at their disposal. And so what I'd like to hear from you on is what you see in terms of the main gaps between central banks and emerging markets today, and what needs to happen to fill that gap to get us to the central bank of the future in terms of building that capacity? Because the challenges, you're right, are all the same. So how do we get everybody sort of in the same conversation? And then I'd like to ask Michael to specifically sort of reflect on whether there's a role for the development community and philanthropic capital to help in some of that. Because I would posit that, we love throwing attention and money at shiny new objects and business models, but there's not a lot of attention always put to the regulatory side of things and the rails that sort of make sure those business models don't kind of drive us off the road. So maybe you could respond first, Lobna, and then I'll ask Michael.
As I said, I mean, central banks, emerging markets and developing markets, we have a challenge with our resources, be it human resources or capital, but we have also a very huge opportunity, which is that our populations are always young. We have a high percentage of a young population, and young population means more agility, they have the tools of this era that maybe we as older people do not have. So I think if we just focus on investing in those young, whether be it at the central banks or in other entities, but the human capital is important, and we have a very good chance of developing this human capital. And there is some responsibility on the countries themselves, because we find a lot of flight of human capital from the developing countries to the developed countries. It should be the other way around, or at least we can maintain our young people that are being well-trained, well-educated in developed countries, and then they don't come back. So we need to work on that, because this is the capital that we have. in terms of infrastructure, I think this is again something that we need. Maybe some of the countries will need capital, but I personally, I always believe it's the transfer of knowledge and know-how that is important. But specifically for this topic, financial inclusion going forward, some of this transfer of knowledge is even should happening between developing countries themselves, because it has been a focus area for many countries. So, and that's, for example, why the AFI alliance is successful. This is a member-driven alliance. It is focused on developing countries, and there has been so much knowledge sharing between us as regulators that we build now on. We have case studies and so on. So I would focus on the human. Money can come. We have the international donors, we have the IIFs, and also I would say that this is a business opportunity. It will draw money from the private pockets, not just donors or international organizations. It is a thriving business that will make money for everybody. So the private sector has to be also will come, and we've already seen them coming.
Michael, would you like to?
Yeah, I think there's a huge role and a huge need for new technology. Let me just step back a minute. What's the risk if central banks get this wrong, right? There's three ways that they can, frankly, destroy financial inclusion. Forget about promoting it, right? One is if they block innovation, right? The second is if they fail to manage and mitigate risks and things blow up and people lose faith in these systems. But the third is that they regulate these systems in a traditional manual way that destroys the economics, right? It's very, very difficult to serve the poor at a profit, right? You really need to get your marginal costs down very close to zero. And if you have to, invest millions of dollars in supervision, reporting, and so forth, it'll destroy the economics of these systems. And so central banks need to balance letting in innovation, mitigating the risk, but doing it in a way that doesn't destroy the economics. And I think technology is a solution. So I think what's called RegTech, SoupTech, more standardized methods to gather and analyze data. There's huge opportunities as you start to have standardized payment systems. Now you have the ability to analyze that data to identify fraud. How do consumers report misdeeds by providers, and how do you respond to that? Because again, think about in a developing world context where you're going from 20% financial inclusion to 80%. You have 4 times as many consumers and a much wider range of financial service providers that you need to now supervise and protect. You can't use the old traditional way. So I think technology is a huge importance. I think to your question of is there a role for philanthropic organizations, for development organizations, I think absolutely. It would be a huge mistake for every country to invent their own technology and their own approach. I think we have to be learning from each other. If you want to attract private sector companies that'll bring the latest technology, they need to have scale, so some sort of standardization of the tools for regulators is required. And it's a really new area. So for the students out there, if you want to go out and start businesses, RegTech and SoupTech, I think, is a huge opportunity and a huge need.
I actually really like both of your responses because they go together, right? So technology can help make things more efficient and help banks operate better, but you need the human capital to run the technology. And I think one of the things that's so fascinating about India, for me, you talked about sort of brain drain and how you make sure that stays in your country. India is, in fact, a brilliant case in point. A lot of that was driven by super smart engineers and economists who trained somewhere else, came back. And you've got this hotbed of amazing talent sitting in Bangalore, Chennai, and other places. And so I think, there is a real imperative for governments to think about how they mobilize some of that talent and use that to sort of leverage the technology. So I think really great points. I want to just give 2 minutes each to Sophie and Ajay in case they want to jump in on that or any other question. And then I'd really like to open it up for questions from the audience. So I don't know if you have anything you'd like to add.
So Michael, what you said is so interesting, and I think it's bang on. what we have found is that in India, there is a large number of regulators. There are many different regulators. And in my organization, we've been very intimately involved with regulatory processes. So we work on building state capacity by improving processes. We've been dreaming, and we have begun building open source systems that would do the internal processes of these regulators, and that would intermediate the information flows between the regulators and the private firms out there with exactly the sorts of things that you had in mind. And we think of it as a twin objective. The first is to short circuit the effort and the delay required for each organization to build its own capability. That, if somebody's worked hard on it, and if you can stand on the shoulders of the developmental work that has been done somewhere else, all the better. And the second is to move the interface between the regulator and firms to all electronic as much as possible. And our mental model is basically there should be a back office process at night that runs in a regulated firm, which does a bunch of compliances. And for the rest, the world of business is extremely low friction. So we've actually begun the process of building open source regulatory process software. I don't know which buzzword it fits under.
Well, we can invent one. Sophie.
Yeah, I think that the human infrastructure is key. And I like what you say about working on the processes. I think for telecoms regulators as well, in the era of digital transformation, there is a need to revisit some of the governance processes and procedures, dispute resolution, sanction, enforcement, licensing. I mean, our fintechs, tech companies, when you use drones, when you use blockchain, how do you license them? So it's licensing procedures you really need to open your mind. And I also salute India in terms of digital financial services. We have actually provided training on DFS, bringing in the results of our focus groups to people across the administration. So it wasn't just the telecom regulator, it was working with the telecom regulator and others in civil servants in the administration to tell them, here's what digital financial services are. So it's that openness, bring in those pockets of expertise and try and raise it across collaboration, across administration, because that will make collaboration easier.
Perfect. Okay, so we've got about 20 minutes left, I think. So we'd like to open it up for questions from the audience. Up here? Can we get a microphone up there? Up in the back corner there.
Leonardo Gambacorta, Bank for International Settlements. First of all, I would like to thank the panelists for your discussion. It was very interesting. And I want to make a point about coordination, and in particular, international coordination. Because in the discussion, it was clear that we are in a situation in which there are now 3 different objectives. That is, for example, if we think about the financial side, the financial stability, competition, but then we have another objective that is data privacy. So Professor Shah said that we need, following the Timberger rule, we need to have, for every objective, we need to have just a tool, to apply this tool. So this means that we need the coordination at the national level between the prudential authorities, competition authority, and data privacy authority. So it's already a lot of coordination at the domestic level. But then there was another element that was very interesting, is that there is, in terms of welfare maximization at the country level, a different society preference across countries. So for example, an advanced economy could weight more data privacy, while an emerging market economy with more need for financial inclusion could weight less data privacy. So there is a question here about a minimum standard for data privacy, data sharing, and so on. So the question is, do we need another standard setting body for the data, for the sharing of the data at the international level?
Great question. Who would like to try that one out?
I would say the whole area of data privacy, both facilitating data, because there are the people that say the poor and developing world don't have primarily a privacy problem, they have an invisibility problem, right? So there's real benefits to data sharing, real potential benefits, but there are real risks. I was in New York last week during the General Assembly, and in every single meeting, data was the top issue. And it's clear that we don't even have the right framework to figure out how to approach the problem, how to even break it down. So there's a lot of work that needs to be done, and a little bit of agreement on frameworks, and ultimately, potentially some standards. Right now, you've got radically different approaches in the U.S. versus Europe versus India versus China. We're far away from even an agreed view of how to make off those trade-offs, and I agree with you. There's different cultures, different societies will make different trade-offs between privacy and access. We may ultimately get towards a standard-setting body. I think Jennifer asked this morning, does the central bank of the future need to manage data? I suspect they'll have a role to play, but it's a much bigger issue than just financial services, and there probably is a new entity that needs to look particularly at data, because it'll be cross-cutting.
Yeah, go ahead.
I want to think a little more about the trade-offs involved when different countries view this differently. Okay, so if you think of today's Germany, this is a country with deeply entrenched liberal democracy and civil liberties, and when there are questions about data and surveillance, we can be reasonably optimistic that they will work out well. But this could be different in different countries. The thought experiment I would like to play to you is, would the world be different if Leonid Brezhnev was given modern surveillance technology in the USSR? Okay, would the USSR have come to 1989 if the Communist Party had sufficient surveillance technology? Okay, so these are very important trade-offs, and there is a path dependence in these things. Once a society is set off in the direction of executive power and access to surveillance, then potentially you have permanently changed the trajectory of that country. Similarly, on these trade-offs, I was struck by the political debates in the UK, which led up to the decision that even though we have considerable depth of liberal democracy in the UK, they chose to not do biometric ID because they felt that it would do harm to the political system. So I think we need to think much more about these trade-offs.
That's an excellent point. Not to mention that, and I'm British as well as American, we were too cheap to pay for it. That was part of the debate at the time. but I actually, one other point, because I've heard a couple of people say, there's this trade-off between data privacy and we want to take advantage of the opportunities of data in low-income countries. We've just done some recent research saying, actually, we have to challenge this assumption that poor people are happy to let their data free, because we did some sensitivity testing around this. Very poor people are willing to pay to make sure their data is not shared without their permission, both in time and monetary terms. So I think we have to be really careful about assuming that poor people are just willing to let their data be used by anybody. So I would just caution against that assumption.
So we've spent a fair amount of time discussing how new technologies can promote financial inclusion, but it's certainly quite possible that new technologies also create greater exclusion to certain groups. And a good example would be in countries such as Sweden, where cash usage has fallen to such low levels on the order of 1% of GDP, that it's very difficult to use cash in many transactions because merchants have to drive 20 miles to deposit the cash at the nearest bank or ATM. And so I was wondering what your perspectives are about the role of central banks in trying to redress this financial exclusion possibility, in particular, whether it's really incumbent on central banks to bear the costs of making sure that there's for instance, uniform medium of exchange available to really most of the population, at very low cost.
you don't volunteer, I'm going to randomly select you. Would anybody like to take that? Jay?
I think that there are positive externalities upon society when poor people will be better connected into the financial system. So I think there is a case for vouchers.
But I think it's a transition problem, not an end state problem, right? I think but it's significant, and it's something we deal with all the time. A lot of the investments we make is to support government in digitizing government payments to the poorest individuals. And there's a real risk that you're actually doing them more harm than good because they can't readily make access to those payments. So it's absolutely a balance that needs to be stricken, but it's about how do you, in our view, it's about how do you progress the system so that people can take advantage of these digital platforms. It's a challenge. And Sophie's point is absolutely right. And I think we totally underestimate the risk of what if we move everybody to a digital system and the network goes down for a month, right, which is not at all inconceivable. What do you do? Running banks in Southern Africa, we had multiple backup plans, right, where ultimately you would have to go back to your branch, but every branch would have the data there, and you'd have generators to try to get back your data if the system went down. A lot of these new systems have no backup plan and no redundancy plans, and I think it's a huge risk.
Okay, Sophie, and can we get a microphone down here? We're going to go to Jennifer next, but then we have a couple of hands up over here. I don't know where the microphone on this side of the room is. Oh, okay, we have another person. Okay, so Sophie, go ahead, and then we'll go to Jennifer, and then we'll go to the back.
And I come back to the point that I made before. There are groups that may be excluded, including persons with disabilities, if it's not, and if it's retrofitted into your policy and into your activities, it will become a much larger burden for those implementing. Let me give you an example in the telecoms world. If you have, for example, the vision of government that we want all our schools connected, and that's integrated into policy measures, into regulatory measures, including into licensing obligations of telecoms. But you forget to integrate the need that there are children with disabilities. That $100 laptop now becomes $3,000, or there are excuses that are found not to do it. So you really do need to think of it from the start, digital first and digital for all first. And so there, in financial inclusion, let me put that to you as well, financial inclusion for all.
Okay, so we'll take a question here, and then we'll go up there.
Just a quick comment. I really appreciated both of your comments about data. I agree completely. It needs a superstructure. But on this issue of coordination among central banks, among countries, there is an interesting example that might be worth considering that's unfolding real time here in the United States, and that's the work that the Conference of State Banking Supervisors is doing to bring maybe not all 50, but as many states as possible together around licensing, regulation and supervision of state licensed money service businesses and other kinds of actors. And from an innovation perspective, there are many things driving them, but one of them is the fintech community saying, I can't afford to go the 50-state licensing route because I'm being asked for fingerprints from every single one of my boards of directors, blah, 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 50 times over, among many, many other challenges. Can't you guys and girls kind of get it together? And the CSBS is making really important strides in common technology systems. And it's not just about the technology, though. It becomes a huge issue around process and also around what your existing laws require. And I think one of the things they've found that's really interesting is how much of this is really an issue of what's prescribed by my state law versus what's just process and procedure and custom. And I think they're finding far more of it is the latter than the former. And so I think there's a hopeful story there that might be useful as we think about how to do that on a cross-country basis.
Great, thank you. I want to take the question up here because I wasn't able to see you before. Go ahead.
Yeah, I've been part in the past of an organization called Children and Youth Finance International, and one thing they did, it was just working with local nonprofits to do financial education amongst young people. But another kind of vision, if you're thinking about central bank of the future, is, you know, every child born in the world will have an account in their name when they're born, which will lead to ID, and it will provide an opportunity for international donors and foundations to kind of do those deposits without going through a lot of intermediaries. And I just wondered, one, if it's even possible, and if that's something that would be entertained in the future.
Who would like to take that question?
You have this in Sweden, I believe, Mr. Governor? You have this in Sweden, I believe, that with every child born, they have the bank ID.
Yeah, I mean, every individual born has an ID, and that has been around for a long, long time, and that's completely a non-issue in our cultural setting. So to define who you are is a non-issue in one way or the other.
But she wants to have to, yeah.
And I had a discussion just yesterday about whether, as you get an ID, should it automatically come with a bank account? But there's obviously issues around with which institution, and I think you'd want to couple that with easy portability, but it's absolutely possible.
Okay, so we've only got 5 minutes, and we've got a whole bunch of hands. Joanne's had her hand up for a while, so can we get a microphone down here? And then I think Babak had his hand up over here. I know, there are like dozens.
Thank you. Joanne Barefoot with AIR, the Alliance for Innovative Regulation. Fantastic panel. Ajay, I'd like to go back to what you were talking about on open source. Michael made the point that if we don't modernize how the regulators do their work, the cost structures will never support full inclusion. And there's a nascent conversation that I hear around the world about regulators moving to an open code and interoperable layer. Can you talk more about what you think is the promise of that and the pathway toward it? I think a lot of regulators hear those words and it sounds alarming, sounds insecure and so on. So talk more about that.
Well, I'll just quickly say two things. One is exactly as Sophie had begun, there is a drill in every regulator. There is a licensing problem, there is a dispute resolution problem, ... So by the time you study a large number of regulators, you see those design patterns. The same things are happening over and over. Then this part two is really, I would say, a self-interest of a regulator. That when you wish to improve your internal systems and processes, would you like to start from scratch? Or would you like to start from a community of practice that has thought a lot about it, has developed a thorough process manual for how to do it, and that is available in an encoded open source software system that you're welcome to modify for your own internal purposes. So I find that this is a nice and useful way to proceed. It is non-threatening. It doesn't put any discomfort upon the organization that might choose to adopt some of this work.
Yeah, thank you, great panel. I'd like to throw a hot potato at the panel just for a question. I feel that we're always trying to play catch up and play in a reactive way to big data, right? When we talk about telcos, banks, and others, we talk about regulated entities, but when it comes to big data, it's an unregulated entity right now. And Greta's comment was very interesting, which is a lot of poor people actually would like to be very guarded about their privacy and their data. There's a project at Harvard University I'm trying to learn more about. It's called Data Integrity. The whole premise of it is that we pay a little bit more for some of these apps that we use and instead get nano payments back. And these are not insignificant. Estimates are that a typical US family could get $20,000 a year through all this transfer back of the money and redistribution. So is this relevant for financial inclusion globally? And is there a reason why almost nobody talks about it? Like I've been to a lot of panels and everyone talks about a lot of interesting, important things, but we're not going to the root of it, which is the transformation we experienced from land to capital a couple of 100 years ago. Now we're seeing it from capital to data. And it's like almost there's no redistributive element here at all. So I'm just curious if there's any comment from anyone on the panel.
I would say everyone's talking about it, no one has any answers, right? But the whole question of ownership and agency of data it's a huge issue, but we're right at the beginning of trying to get our hands around it.
I don't know if we have time for, okay, one more question. Random, okay, I guess. She's had her hand up. Okay, please. And I'm sorry for those who we missed. There was a lot of hands up, so.
I feel fortunate, Aaron Klein Brookings. I wanted to link something that Jen said with something that AJ said and see people's reactions, which were, AJ, you said that in India, there was a policy choice to ban the fintechs from access to credit bureaus. And Jen...
It's an example of the policy risk that is unfolding every week. We in India go through one unusual policy action every week.
So risk reward, right? Jen made a comment about Equifax having a stale database of old information on folks. Melissa's organization has come out with a fantastic paper showing the benefits of cash flow underwriting as an alternative to credit scoring. And Manju Puri has a fantastic paper looking at Wayfair lending in Germany, where 5 fintech variables outperform German FICO on an actual loan pool. So the question I have for both AJ and the panel is, do you think that banning fintechs from credit reporting agencies will produce better, the same, or worse outcomes in terms of accurately measuring risk and risk-based pricing for lending?
No, I would like to focus on the question of state power. If I was a fintech, I am entirely in your shoes that the new age cash flow based measures are phenomenal. But do you really want to use government coercive power to force fintechs to not use credit bureaus? That's where I get nervous. And that's the concern about creating a very state-led edifice where the business models are being controlled by the government. The NPCI has given limits to WhatsApp on how many number of accounts it can have. There is newspaper talk about NPCI asking Google to cap its market share at 33% in payments and so on. This is the sort of stuff that I worry about, that if we go down this route of state control, then we will lose out on the innovation.
Would anybody else like to jump in on that?
I think it's a very delicate balance that has to be played. And I think if the state is involved it should be involved just as a catalyst and an enabler. But even if they have something more than that, they have to come out to the market and explain why. I mean, if this decision was taken, then they need to go out. If I don't want to stifle innovation and make sure that I still have the buy-in of all the players, then we have to come out and say why. Maybe they have a legitimate reason, I don't know. But it cannot just be done by that's it and it has to be enforced, because these players have come within a certain environment with certain rules and regulations, and it cannot just be taken out like that. So this balance has to be there, and I think the most important thing is transparency and accountability.
Yeah, the whole question of regulating credit is a difficult one, and it comes back to financial health, right? Is more credit better? Is it the state's role to protect people from themselves? Those are pretty deep questions. I don't know whether your question of whether you get better underwriting results with less data was rhetorical, but I don't think anyone would say you get better results by restricting access to data. But that, I don't think that was the. Oh, you would say that? Oh, maybe so.
There's a musical analogy that I like to use, which is that the orchestra tunes to the oboe's A, not because it's the truest A in the orchestra, but because it's the hardest instrument to tune.
Okay, I think we've gone over our time. I'm not going to do a massive sum up, but I think there's some really interesting messages coming out. Between the tension between control and innovation. What's the appropriate role of government? Is it directing? Is it running? Is it overseeing? Is it nudging? I mean, and I think to your point, Lobna, it's a very delicate balancing act on all of these. And what technology and particularly data is doing is really challenging us on where that point of balance is. I like a point that somebody made about being really clear about the objective you're trying. What are you trying to solve for in some of these policy questions? And I think that maybe drives towards a better outcome. And also just the need to invest in technology and people. So as we think about what our central bank of the future looks like, there's a big need to invest. And that's not just in emerging markets, that's in developed markets too. And so how do we think about doing that? Clear mandates, but also collaboration between institutions seems to be very clear. And between the private and the public sector, talking to each other really makes a huge difference. So on that note, I'd like to thank my panel for talking to each other today. I think we've had a great conversation, and thank you for all the questions from the audience. I'm sorry we didn't get to all of you, but hopefully there will be opportunity to speak at the coffee break. So thanks very much.
Thank you, Greta, and to the panel. Lunch will be served in the atrium just outside. It's a buffet lunch, and then please make your way to the Great Lakes Room where we were yesterday for our second panel that will begin at noon.